This Saturday, we have two interesting webinars only for you. At 11 a.m., we have Kodeeswari Women Only Webinar, Investment Masterclass with Kodeeswari. And at 11 a.m., we also have an Corporate India What Q1 FY26 Earnings Tell Us About the Road Ahead by Mr. Sendil and Mr. Gaurav. What are you waiting for? Please register today.
As an investor, if I started my own portfolio, I would never do it this way. I would start with a base capital and keep on adding periodically to the portfolio. Why do I add more money to a portfolio and that too periodically? What is the benefit? The benefit is that my initial capital creates a starter portfolio, a base portfolio. Later, as the market throws more opportunities at me, I keep adding incremental capital in smaller packets. Let's say I start with a 50 lakh initial corpus. I keep adding 2 lakhs every month. So, in a year, I would add at least 24 lakhs. I keep another sum of money for any day on which the market falls significantly. Let's say I keep another 10 lakhs. Now what happens when this 2 lakhs comes into the portfolio every month is that it doesn't go in and buy all the shares in the same proportion like a mutual fund does. In a PMS, we are free to buy wherever we see the best value. So typically what happens is every month this money goes to that part of the portfolio where the opportunity looks best and the valuation is in our favor. Imagine making decisions like this every month. In addition to this, there is this corpus waiting, let's say in a liquid fund, which gets invested in a sharp market decline. Let's say this is steep fall. At that time, this 10 lakhs goes into the portfolio and it further helps me buy companies which are most attractively valued after a market correction. Assume you do this regularly for a period of 3 to 5 years. What would have happened? Yes, you would have put a starter capital of 50 lakhs, but you would have added anywhere between 24 and 35 lakhs. So, you would end up over a period of 3 years investing just over 1 crore. And over a period of 5 years, close to 1.7 crores. In addition to the original sum of 50 lakhs. So, you would invest anywhere between 1.5 and 2.2 crores. And this is over a period of 5 years. But what you would have actually achieved is that in your portfolio, in every correction, your money would get deployed in a specific stock opportunity which corrected more than the market and where you believed more and where the fund manager bought into by taking a contrarian view to the market and showing conviction when the market was running low on conviction. Now this, when done continuously and repetitively in a portfolio over 3 years, can deliver significant alpha. You will beat the benchmark too, and you will get the confidence to scale up your portfolio significantly, because you would have put anywhere between 1.5 and 2.2 crores, which is very close to 250,000. And chances are, over a period of 4-5 years, this money would have also doubled. And you now understand that if you leave this money untouched to compound for another 5 years, you are certain to achieve $1 million milestone. Now, when the engagement between the investor and the portfolio manager becomes deeper and deeper over a period of time, and the deepening of the engagement doesn't happen by putting very large sums in one go, but by regularly adding to the investment portfolio and contributing money on a monthly basis, and also keeping some powder dry for a very, very rainy day on which opportunities would be the best and most attractive. You give yourself a lot of time to build your conviction, to build your portfolio, and your portfolio and your conviction get built side by side, concurrently. And they help each other. Your portfolio helps build your conviction makes you put more money regularly, and that in turn helps the portfolio grow further. That further helps you build your conviction even more. And this synergistic process keeps happening continuously for years together. Ideally, this is what should happen in a PMS. But this doesn't happen because most people do what I think is simply not the done thing. They give 50 lakhs and tell the manager, I will see for 1 or 2 years, later if I like, I'll put more money. Chances are, when they like the returns in this portfolio, it may not be a great time to top up into the portfolio because the performance may be at its peak and these guys are going to give money when the valuations are also elevated. Now, that's not going to produce the desired results, and that's not a good playbook on how to invest in a PMS. I would think that beyond the starting capital, investing every month, like an SIP, into a PMS is definitely the done thing. Also, keep 20% of the corpus aside so that you can make a lump sum payment in a significant correction. If you follow this playbook, I would think you can succeed far more in a decently managed PMS scheme than in any other product. Also, make sure that the churn in the PMS is not high. The fund manager has a track record of buying and holding for a long period of time, and the portfolio doesn't change too much year on year. The buy and hold strategy runs in most of the portfolio. Only a part of the portfolio is churned. And that churn also leads to improving the quality of the portfolio every year. If you have understood your manager well enough and you're confident that he would do this, then you should be investing every month into a PMS also. And be willing to invest a lump sum whenever the opportunity looks very, very attractive. If this becomes your investment playbook, then you achieve scale in your PMS. And when you achieve scale in your PMS, the PMS scheme that you invested in becomes a vehicle of wealth in the genuine sense and can often grow into a $1 million portfolio and maybe much more. That scale is what is very important in a portfolio manager investor relationship as the desirable outcome. We should work towards that outcome, and if we work towards that outcome diligently and continuously, we are likely to achieve far more even in a PMS. Not many people do this, but those who do this are certain to receive all the benefits of disciplined investing and sustained investing. Contributing and participating are as much success secrets of a good portfolio investment, of a good PMS, as great stock picking is. In fact, continuous contributing and participating is far more important than great stock picking because they help achieve scale in individual stocks and scale in the overall portfolio. Nothing can help you reach bigger milestones faster and with certainty. Thank you for watching this video.